Teqnion AB. Teqnion is a small industrial company based in Sweden. They are a serial acquirer who has gained some traction amongst notable investors despite its relative size. They have gone through a rough patch in the latest 3 years where management has made some mistakes that they have been very open about. This has meant that both the company as a whole, the subsidiaries and the stock has had poor performance. The question remains whether the management can turn the trend around and deliver strong shareholder returns in the future. At a share price of 155 SEK per share, the company trades at a market cap of 2.6 billion SEK or around $260 million. This is amongst the smallest companies within the serial acquirer space, which perhaps has contributed to the popularity of the stock. Who doesn't want to get in early on what could be a decade-long journey of strong shareholder returns? However, such a journey are not as easy as one would hope for. Teqnion has seen poor growth rates both in revenue and free cash flow. The returns on invested capital has been declining and now sits at only 10%. This is usually not a business you want to own for a long term. However, I believe the company will increase its return on capital, as well as improving its incremental return on capital towards 15%. If they could do this, the shareholder return would also approximate towards 15%. I have been quite critical of this company in the past due to some yellow flags. I believe it's for the better to raise these concerns straight away. The company has had some trouble finding a CFO that stays for longer than a year at a time. The CFO position is very important, and many ins and outs of the CFO role, without a good explanation, is a yellow flag in my opinion. Are there any disagreements when it comes to internal or external accounting, for example? I'm pleased to say that the company now seems to have signed a CFO that actually is going to stay for some years. Let's hope so, at least. A second yellow flag for me has been an increased capital base but a declining profitability. This is a classic scale problem and may suggest that the founder CEO is not the one to bring the company over to the new phase. In general, a CEO that takes a company from 10 million to 100 million may not be the same as the one who takes a company from 1 billion to 10 billion. These journeys require different tools, and some management teams simply don't possess all the requirements. Note that I'm talking in general here and not suggesting that the Teqnion management won't be able to do this journey. It is, however, important to be aware of this phenomenon. A third problem has been some governance problems, mainly related to insider transactions, as well as some questionable hirings in management. I believe we have received some good explanations for the insider transactions, where management has learned mistakes when it comes to disclosures. The last negative point I want to highlight has to do with the accounting of the firm. When you acquire a firm, the purchase price, above the assets of the company that you acquire, are often allocated to goodwill. However, under IFRS accounting rules, you should try to identify assets that are not recognized on the balance sheet. This will make goodwill lower, but other intangible assets higher. This could be assets like customer relationships or technology assets. If this is too much information for you about accounting rules, you only need to understand that a lot of goodwill makes future earnings look better, as goodwill is not amortized under IFRS. When you allocate everything to goodwill, this makes earnings look good, but makes the overall accounting less valuable to the investors. Goodwill is very likely to be written down in the future if a subsidiary disappoints. A bank may not give you a loan with solid terms if most of your balance sheet consists of goodwill. Other companies, notably the Bergman and Beving Group with Lagercrantz, as well as other companies like Lifco, allocates a much higher portion to other intangibles than goodwill. This decreases short-term earnings but makes the balance sheets of the companies cleaner and more trustworthy. Also, it's less likely to be manipulated. If you're interested, take a look at the goodwill versus intangible assets for Teqnion versus other serial acquirers. The difference is stark, and I would say that it's a yellow flag for Teqnion. The reason why they do this, I think, is because it's complicated and time-consuming. For a cynical or skeptical investor, it may also suggest some other things. The company may want to increase short-term earnings. This could make it easier to get a high stock price, which can be used to dilute shareholders. Okay, so why am I interested in a company with so many small things that I have an issue with? First of all, I believe management has been pretty humble regarding their mistakes, and it seems that they have learned quite a lot of things in the latest years. They were inexperienced, and now they are older and wiser. I believe the CEO has had to learn some accounting and financial data the hard way. I believe the Chief Investment Officer has had to learn that a business on paper is something quite different than a business in real life. The most important thing, however, is that these guys seem humble, driven, and eager to learn. They have skin in the game and own and invest a lot of stock. They are in it for the long run and truly want to be a permanent owner of good businesses. Teqnion has a legacy of owning perhaps not so great assets and has seen tough years as a consequence. Now, management will deploy capital at a higher pace but will adjust their risk as well as business quality when acquiring. Teqnion has a strong shareholder base who has not left the company despite the disappointing years. Therefore, this could be the start of a very long investment journey where we are only in the infancy. Teqnion previously paid a dividend but has decided to retain all capital in the business and buy new businesses. Many serial acquirers in Sweden does pay some dividend, but it really doesn't suit such a small company as Teqnion. This is a welcome change and they should be able to deploy all free cash flow due to their size. Because the business is still relatively small, most of its capital will be deployed after 2025. If Teqnion grows 10% annually and reinvests all profits, over 60% of its 2035 capital will have been invested during the next decade. So, if future returns on capital improve, most of the company's capital base will earn those stronger returns. This is the crux of the investment thesis and shows the power of a high reinvestment rate coupled with stronger incremental returns on capital. This is the compounding vehicle that made Buffett the richest man in the universe. Despite the rosy picture I now have painted, the investment journey of Teqnion will not be straightforward. There will still be lessons to be learned for management. Goodwill on the balance sheet today will likely be written down in the future. This is a question of trust in management, and if the company can execute in the coming quarters, one will have increased confidence in that management has learned from past mistakes. I believe this company could become a compounder vehicle delivering 15% in shareholder CAGR going forward. The entry multiple is a bit high on first glance at 1.6 times sales for an industrial company. It trades at a free cash flow multiple of nearly 30 times. But this is very depressed as there has been major issues in their subsidiaries as of late. The valuation doesn't seem very promising when looking at the rolling numbers. However, for a serial acquirer that retains all earnings, almost all value sits in the incremental returns on capital as well as the longevity of the reinvestment journey. Can they compound for 10 years, 15 years, or 30 years? Who knows, but at least they start out at a small scale with a large runway. The reinvestment rate is at 100%, and I believe it is possible to get a 15% return on incremental capital. This is both because of the small relative scale of the company, as well as my belief that management has learned from past mistakes. Meanwhile, the legacy assets are producing returns on a very depressed base and should increase going forward. This would give some boost to short-term free cash flow. I would not be surprised if write-downs of goodwill will make earnings be worse than free cash flow in the coming years, however. Make no mistake, if to invest in this company, you need to entrust management. Many seasoned investors has taken a permanent stake in the company and continues to back the management team. If they can turn it around, you may just have a long-term compounder in its absolute infancy. Thanks for listening.